Hey, if you're watching this, there's a good chance you've made this mistake before. You see a big headline about one of your stocks like Tesla or Palantir, you watch the price jump or fall, and you react. That is, without a doubt, one of the costliest errors you can make. The real money, the real strategy, isn't in reacting to the price. It's in understanding the machine behind the news before the rest of the market does. And if you're in a hurry, here's the one thing you need to take away from this video. The new Palantir and Deloitte alliance isn't just another partnership. It is a direct, strategic, and powerful solution to Palantir's single greatest weakness for the last decade: its inability to scale. This changes the entire equation. If you want to understand the why behind these kinds of market-moving events, not just the what, you're in the right place. Consider subscribing so you don't miss the next breakdown. Now, for those of you who are new to the channel, my name is DataCat. I spent about a decade as an analyst inside a Fortune 50 company. It was a lot of spreadsheets and a lot of gray walls. I basically traded that corporate grind for a keyboard and a laser pointer to entertain my cat. He's the real head of research here anyway. My goal is simple: to take these complex corporate events and translate them into what they actually mean for you as an investor. So, let's talk about Palantir. On July 21st, Palantir and the consulting behemoth Deloitte announced a major alliance. They've built a joint product called the Enterprise Operating System, or EOS. Now, when you hear a term like that, your eyes might glaze over. It sounds like pure corporate jargon, but what it actually means is they've packaged Deloitte's industry know-how with Palantir's powerful AI platforms, Foundry and AIP. But that's not the most important part of the press release. Buried in there is this detail. Deloitte is committing to more than tripling its force of certified Palantir engineers. And that is the whole story. To understand why that one detail is so critical, you have to understand Palantir's historical problem. For years, the bull case and the bear case were two sides of the same coin. The software is incredibly powerful, a true game changer for companies. But to install it, to get it working, you needed Palantir's own elite, very expensive forward-deployed engineers, or FDEs. This created a massive bottleneck. Think of it like a world-class chef who can cook the most incredible meal you've ever tasted. But he's the only one who can cook it, and he has to do it from scratch every single time. He can only serve a few tables a night. He can never open a global franchise. That was Palantir. They could only grow as fast as their elite FDEs could handle new projects. It capped their sales and it capped their profit margins. This Deloitte alliance is designed to shatter that bottleneck. First, it's a massive force multiplier for sales. Deloitte's consultants are already inside every major corporation and government agency you can think of. They have the trust of the C-suite. Instead of Palantir's sales team knocking on cold doors, you now have an army of Deloitte consultants who can identify a problem inside a company, say a messy supply chain, and say, we have a solution for that. And that solution is the Palantir-powered EOS. It's the ultimate backdoor sales channel. Second, and this is the core of it, they are building an implementation army. When Deloitte says they are building the largest cohort of certified FDEs outside of Palantir itself, they are solving the chef's problem. Palantir doesn't have to be the only one in the kitchen anymore. Deloitte can now manage the deployment, the setup, the heavy lifting. This allows Palantir to finally operate like a true software company, not a high-end consulting firm. It's the key to unlocking rapid global scale. This directly affects the long-term growth trajectory of your investment. Third, they've productized the solution. By creating a defined enterprise operating system with pre-built tools, they've turned a scary bespoke science project into a more standardized product. For a CEO, this de-risks the purchase. It's not an open-ended contract anymore. It's a defined solution with a Deloitte stamp of approval. My cat, for instance, demands a high-touch bespoke implementation of his dinner service every single night. It's exhausting. Corporations feel the same way about software projects. Standardization is relief. So, the fundamental story here is overwhelmingly strong. This news provides a clear, credible path to faster revenue growth and higher profit margins. It directly answers the biggest question that has held the stock back. Okay, so the story is good, But how does that translate to the stock price, especially with earnings reports upcoming on August 4th, which are always a volatile time for this company? Well, when we looked at the data from the last 6 earnings periods, a very clear pattern emerges, like a standard earnings playbook. In the 10 days before an earnings announcement, the stock runs up about 8.5% on average. Then, right around the announcement, it tends to dip or go flat. But in the 10 days after the report, it rallies hard, an average of over 26%. But there's a catch. We found what we're calling the Q1 anomaly. For some reason, the Q1 reports, which come out in May, have been uniquely poor performers. After the Q1 reports in both 2024 and 2025, the stock either dropped or went nowhere, completely bucking the trend of the other 3 quarters. This is a seasonal weakness you have to respect. Now, let's look at the chart. Where are we right now? The stock is in a classic coiling pattern. It's building energy. You have major support down at 125. This level used to be resistance back, and now it's the floor. It was tested back in January and April and held strong. A break below this would be a serious red flag. It would be the technical equivalent of hearing a crash in the other room. You don't know what broke, but you know it's bad, and the cat is probably involved. The ceiling, the current resistance, is right around $155. Sellers have been taking profits there. Now you might see the recent price dip from that $155 level and feel a bit of concern, but this is actually a perfectly normal, even healthy sign. The stock is simply consolidating, moving between that support and resistance. Think of it like a cat crouching down, just wiggling a bit, gathering its energy before it pounces. And if we look at the momentum indicators like the RSI down here, it confirms this. The RSI isn't in the overbought red zone, it's actually cooled off, trending down from its recent peak. This tells us that the recent dip has reloaded the energy for a potential future breakout without actually breaking the underlying bullish structure of the chart. It's constructive. The final piece of this puzzle is volume. Our data shows that trading volume is nearly 30% higher during the 21-day window around an earnings report. These reports are the catalysts that resolve these coiling patterns. So, how do you put this all together for an actionable strategy? The fundamental news from the Deloitte deal provides the narrative for a powerful breakout. It gives the market a reason to believe the company is entering a new era of growth. The technical chart gives us the key level to watch. A sustained break above that 155 resistance, and the volume data tells us when to watch for it. A breakout is most likely to happen during that high volume earnings window. And based on our earnings analysis, you'd have the highest conviction if this breakout was driven by a Q2, Q3 or Q4 report, avoiding that Q1 weakness. A breakout above $155 on high volume, driven by this kind of fundamental catalyst, would be an extremely strong signal that the market is finally pricing in the solution to Palantir's oldest problem. And this is exactly what Wall Street doesn't want retail investors to understand. They want you to chase the price. They want you to react to the headlines. But the real edge comes from connecting the dots, from the press release to the business model, to the historical data, to the chart. If this breakdown was useful and helped you connect some of those dots, give the video a like. It helps the channel, and it tells the algorithm that you value data over drama. And I want to know your take. What do you think of this alliance? Is it the game changer I've laid out? Or are there risks I'm not seeing? Leave a comment below. I read all of them. Alright, that's all from me today. DataCat out. Stay sharp and see you in the next one.